All right, aspirants, let's talk RBI. If you've got your eye on the GS3 paper, you know how crucial the Monetary Policy Committee's decisions are. And their latest move? Well, it's a big one. They've essentially hit the pause button on interest rates. So in this explainer, we're going to break down exactly what that means, why they did it, and what this tells us about the road ahead for the Indian economy. Let's dive right in.
So here's how we're going to tackle this. First up, the big decision itself. Then we'll get into the why. What were they thinking? After that, we'll look at the new numbers, the forecasts, and we'll wrap up by looking at their official stance and what comes next.
Okay, first things first, let's get right to the heart of it. What was the actual decision that came out of that MPC meeting?
Okay, so the big news is this. The Monetary Policy Committee, or MPC, voted unanimously, everyone agreed, to keep the repo rate exactly where it is, at 5.25%. This is that rate pause everyone's been talking about. It's a huge signal of caution from the RBI. But to really get why this is such a big deal, we need to quickly touch on what the MPC and the repo rate actually are.
First up, the MPC. This is the committee at the RBI that's in charge of setting that all-important benchmark interest rate. Their main job, their whole reason for being is to keep inflation in check. So their decisions literally send ripples to the entire Indian economy.
And their number one tool for the job? That's the repo rate. Simply put, it's the rate at which the RBI lends money to our regular commercial banks. You can think of it as the base cost of money. When the repo rate goes up, it gets more expensive for banks to borrow. And guess what? They pass that cost on to us through higher loan rates. That cools down spending and fights inflation. If they cut the rate, the opposite happens. It's meant to get the economy growing.
All right, with those basics covered, let's get into the really juicy part of this. The big question is why? Why, after a series of hikes, did the MPC suddenly decide to hit pause?
Well, this wasn't a decision made in a bubble. The MPC is looking at a very messy global situation, and the big elephant in the room is the conflict in West Asia. They're worried about how long it'll last, how intense it'll get, and what that means for energy supplies and infrastructure. All of this creates a huge risk for both inflation and growth. It's what economists call a classic supply shock.
And that's the core of the problem right there. A supply shock is basically a disruption in the flow of goods. In this case, the conflict is threatening to clog up global supply chains, especially for something as vital as crude oil. When that happens, costs shoot up for businesses, and that eventually means we pay more for pretty much everything. And that, as you know, is a central banker's worst nightmare.
And we know for a fact they're watching this stuff like a hawk. Governor Sanjay Malhotra even said that the temporary ceasefire was considered in their decision. This just shows you how tactical they're being, reacting to events on the ground in real time. The bottom line here is that global uncertainty is really steering the ship right now.
Now, all this uncertainty isn't just talk. It directly translates into the RBI's official economic forecasts. So let's take a look at the numbers and see how the story has changed. Just looking at the headlines, the picture is pretty clear. The forecast for GDP growth, it's been revised down. The forecast for inflation, it's been nudged up. This is that tricky situation central banks hate to be in, the risk of slower growth and higher inflation at the same time.
So let's put a number on that. The projection for real GDP growth for the fiscal year 2026-27 is now down to 6.9%. That's a drop of 70 basis points or 0.7 percentage points. That's a pretty serious downgrade, and it shows just how much they expect these global issues to weigh on our economy.
And on the flip side, inflation. The forecast for the Consumer Price Index, or CPI, has been bumped up a little, from 4.4% to 4.5%. Now, it might seem like a small change, but it's a clear signal that the RBI sees prices staying stubbornly high for a while.
And this table here, this is perfect for your notes. It lays it all out side by side. You can see the GDP growth forecast dropping and the inflation forecast ticking up. It's the numbers story in a single snapshot. Super useful for a quick revision before the exam.
So with growth slowing and inflation being sticky, what does the RBI plan to do? What's their game plan for the future? Let's get into our final section on the outlook. Their official position is neutral, and this word is so important. A neutral stance means they're not leaning one way or the other. They're not promising to cut rates, but they're not promising to hike them either. They're basically saying, we're going to wait and see. This gives them maximum flexibility to react to new information as it comes in.
And they have a long list of things to watch. The geopolitical situation is, of course, number one. Any disruption there, especially around key trade routes, could send energy prices soaring and push inflation up. But they're also keeping an eye on things at home, like the weather, which can have a massive impact on our food prices.
So this all boils down to a really tough question, and it's one you should definitely be thinking about for your mains. The MPC is stuck in what we call a policy trilemma. How on earth do you support growth when you also need to keep a lid on inflation, all while making sure the financial system stays stable? These goals are literally pulling in opposite directions. So put yourself in their shoes. What's the next move? What are the trade-offs? Getting your head around this puzzle, that's what Mastering the Economy paper is all about.